Ladies and gentlemen, welcome to our session, The Reality of Non-Scripted Mergers and Acquisitions. Please welcome our moderator, Executive Business Development Creative Artists Agency, Brian Weinstein.
Thank you everyone for coming, and thanks guys for making the time to be here. We're going to jump right in. My hope is to make this as controversial and direct as possible and put all these folks on the spot, and let's see if they can answer some of the more tough questions. But I'll sort of start easy to warm you guys up. Ron, who's at Endemol, you've spent a career, and your company has spent decades buying and acquiring non-scripted businesses. So does it work? Why does it work? What do you look for? And be very specific. Tell us some good details we otherwise can't get in this room about businesses you've acquired and companies you've gone down the road and why you would or wouldn't close.
Well, I think a lot of the question about whether it works depends on clearly the talent of the companies we're buying and the valuation. The more we pay, the tougher it is for it to work, which I guess is obvious.
But why is that? I mean, as a seller, and Bob runs a bank affiliated with our agency, we look at it and we say, if you're paying a certain amount, you're paying for that value. Why would the amount you pay create a barrier to the deal ultimately succeeding?
Because it creates higher expectations, and it makes it tougher for us to recoup our investment. So from a seller perspective, obviously you want to get as much money as you can, but you're creating higher expectations the more money you're getting, especially because our deals are built on future performance.
Right. And what are deals that have worked for you, to give you an
all
easy
the ones
question
we've
to
done
start?
have worked.
Exactly. That's not what you told me before we started this panel.
That's true. I think we've been fortunate. The companies we bought, we've done good deals, and we've really focused on the creative sensibilities and management of the people running these companies, and we've been fortunate that from True Entertainment, which was probably 8 years ago, all the way up to Authentic last year, all these companies are still producing and developing a ton of content, and every company we own currently is growing.
And Drew, you're on the other end of the spectrum. You guys are just starting. You, Ben, and Jordan, aggressively backed by IAC, and have just announced your first acquisition. What's going to drive your strategy going forward? How do you think about it? Does IAC, as a broader company that's not done this specifically, how do they drive your thinking at Electus?
Well, I think Ben said it best yesterday, where we're creative-led, so we're really looking for some of the best creative minds out there. We announced Tony DeSanto and Liz Gately yesterday, who just left MTV to start their own label. For us, that's just a clean slate. It's more of, if you think about it, for us, it's more of a venture finance back play. Just be able to get their initial output to be able to build with, as opposed to currently right now looking to acquire an asset. Not to say we're ruling that out, but just something we look at to say, there's all of us, the biggest asset we have is time in the day. And for us, when we're looking at the opportunities to be able to get a great asset like Tony and Liz, it was just a better investment for us.
And with all your relationships and Ben's relationships on the talent side, do you look at specific M&A opportunities based on the actual finances of the company? Like, we want to look to buy a company that's doing X million dollars a year in profit, or do you say, hey, we should be in the business with this particular star because we can grow it more?
I think it always comes down to finances, and that's sometimes in this business the toughest thing, because a lot of people do want to get caught up.
We try and avoid that at CAA,
yes.
By the way.
The thing is, where you don't want to get fall in love with a certain talent without really looking at an income statement or a balance sheet.
Right.
So for us, it's really trying to evaluate. Ben, as most of us know, is one of the best packagers of talent in the business. So for us, it's always, how can we start something and then work with other companies to see where we ultimately get the value on back end.
Right. And Bob, so we've gotten some quick commentary from guys who are active in the M&A marketplace, and you're interacting with endless production companies, from those who are smaller that just starting to bigger places. How do you advise them, given the feedback we get? What should they do when they're building their business to think about the ultimate exit? What do you think about timing? And what would be some just basic starter advice on this whole opportunity?
I mean, I think it's important, first of all, to understand the market. So when we're giving advice, we're talking to them about what private equity companies are looking for, what hedge funds are looking for, and then what the strategic buyers are looking for out of their acquisitions. And then it does come down to timing. So what we look to do is give advice on helping the companies know when it's time to go to the markets, when they've executed over a certain amount of years, when their cash flow is getting to a ready state, and when they can get the best deal out there. We continue to look for buyers. We're approached by funds all the time who are looking to get into this space. They love the space. And the banks are now coming back and lending into the space, and they're interested. So I think the timing's gotten a lot better, but it does come down to when the company is prepared from execution and financial standpoint.
I think we talked about this before, is that the unique thing about this business is talking about the creative led, they're led by entrepreneurs that are their own brand, that are leading what the output is. This is something that's quite different from, if you look at a tech, investing, where it's a product, it's an idea, it's intellectual property that, some source code or what have you, that gets VC. These are always kind of like a team or one person that's leading the charge. And so when you think about that, it's a lot of times it's their own personality of when they want to sell, or what's the best timing for them, and what's the best outcome for them.
Right.
Which leads to valuation questions.
And I mean, let's talk about the boring stuff, which matters the most, which is, which is valuation. So, Bob, if you can take a second, and Ron, maybe you can respond. I mean, how do the current economics in the world affect value prices? And Sandra, maybe you can jump in too. The ability for Endemol or Lionsgate or Electus to borrow money is going to affect what they can pay. So maybe you can shed some light on that.
Yeah, I mean, however the deal structured, it's all based on return to the investor. So, the bank markets have caused, concern on the fact that they're not lending into the industry, so the investor needs to put more equity in, which hurts their return. So they're going to be more cautious. And most of this is based on an EBITDA multiple. So the multiples that if you're getting high leverage, you're going to get a better multiple. If you're getting low leverage, the multiples come down. And then what we're saying about the entrepreneurs, really, these are their businesses, and it makes them uncomfortable about what they're getting as a valuation.
Right.
But a lot of it depends also on what you're buying, because when you're buying a straight entrepreneur without assets, right, without a library, you don't have a cash flow, you don't have any reliable return that you can guarantee, it's going to affect your valuation. It's going to affect it. For us, it makes us think about, okay, the most important thing you're looking at is that personality, that management. How are you going to guarantee that management? So we're much more focused on issues, of course, valuation, but unless you can guarantee the management, you make an overall deal.
That's right.
It pushes the cash flows out.
Well, so that's a good question, and maybe you can comment on that, and then Michael, get your response as someone running their own production company. Why buy versus do an overall deal? And how, in your experience, does talent and producers respond to the conversation of overall deal economics?
Everybody from the talent side, in my experience, would much rather have an acquisition. They'd much rather be acquired than have an overall deal. Nobody wants to be an employee. And people are looking to build business. And in many cases, in certain cases, you've got guys like Michael who have the capability of building a business and bringing value beyond just an individual show. You want to be part of a brand building, particularly if there's some strategic nexus with your company. It makes sense to have that asset in-house. But, we look at a lot of the more established companies, guys with libraries, and there's always that concern that they're looking to cash out. And if they do, there's a big exit 2-3 years down the line without an interesting employment package. You've got a shell company with some assets and no ability to manage growth.
Right. And Michael, as someone who, ran a network and created great programming as an executive and then started out of the block, you've been in the midst of numerous discussions around acquisition, around overall deals. What's been your experience, and sort of what would you say out of your experience to others who are starting to consider what path to go down for financing or a potential deal?
Right. Well, I think there's a little bit of a structural disconnect between what I do and what these folks want, which is basically, as a creator, I want to create shows. I want to go out into the marketplace. I want to sell shows. The TV marketplace, after a year so horrible that I was ready to get out of the business, starting in 2010, took off, and it hasn't stopped, and it's been an extraordinary ride. And I just want to go out and make shows. And I realize that's not a strategy, but there's a strategy within it, which is really to build one's reputation as a hit maker, and build the level of confidence with buyers, as many buyers as possible. So that's really what we're in the process of doing right now. The difficulty with the business right now, of course, is rights retention, and creators lost a lot of ground to distributors on the rights front, and I think that that's where, strategically the hookup is has a potential opportunity. But the danger is, and certainly what I've discovered in a number of these conversations, is some of the studios and some of the financiers are not really interested in anything unless they can, fully exploit the rights, which is completely understandable. So it's figuring out how to sort of fit a square peg into a round hole, and I think there are probably some discussions to be had around that. But I think that's where the ongoing tension is, and that's where I've been a bit resistant to shack up.
Right, and but maybe there's some comments, but before we get into the ownership issue, which I think is a really important one, why, besides money, which overwhelmingly is the reason to sell your company, 99% of the reason at the finish line, but up until that point, Ron and Drew, Sandra, you're selling your company as a partner, because so often these deals are earnouts, and so you're paying a certain amount of money up front, and then you're paying more dollars over time. And so the entrepreneur, the producer, is saying, well, if I'm in business with Drew, he's going to grow it, and Alexis is going to grow it for me. One, is that true? Does it really matter? And what are you guys selling when you're in that process and you're trying to buy a company? So whoever wants to jump in.
I think we've kind of set our company up a little bit differently in the fact that, we hired a guy like Jordan Hoffner who ran content at Google YouTube, because at the time of rights retention, the conversation, a lot of people say, well, maybe digital's an avenue to be able to get some rights that way. So we have a person that really is immersed in that business. We also have somebody who says, leverage the advertisers. So we have someone, Laura Caracola Davis, who came from Starcom, ran branded entertainment there. So maybe we go to the advertiser and work with them closer to be able to retain some of those rights. So we've kind of set this company up, Electus, as a holding company, if you will, to be able to have specific knowledge in these areas, to be able to see if we can leverage these different points, digital or advertising, to be able to retain more rights. So that's a selling point for us. And also it's kind of the benefit of a Ben Silverman, one of the greatest salespersons in our generation.
So if we're opposite you at CAA or Bob's opposite you at EMC, do you think at the end of the day that the producer is going to do the deal? Will economics drive everything, or can you feel like, look, we can pay less, but we're offering you more? Do you at the end of the day believe that's going to make a difference?
That's our proposition. But the reality is that it's really about that individual, what their goals are, and what the outcome that they want. If somebody just wants to get a big payout and then just ride it for a couple years, that's one. If we could sell a story of that, this isn't something that just ends after the earnout. This could be something that continues on because of the proposition that digital could grow, which we all expect, or advertising is going to get more immersed in the business. So those are some of our levers that we kind of talk about.
Okay. Ron, any thoughts?
I think for us it's similar. Endemol is first and foremost a content company, and we focus most of our energies on finding people who create great content. So the last thing we want to do is bring them into our company and change how they operate or really impact their business. We're trying to find responsible people, and we've been successful in doing that. And so the biggest thing I think we sell is a combination of autonomy and resources. You come in, you're acquired by Endemol, you basically continue to run your company the way you ran it before, but now we provide a lot of the same resources that Drew mentioned, merchandising and digital and international distribution and things like that, which, number one, hopefully result in retaining more rights, and number two, allow you to maximize the dollars once you have those rights.
Right, and Sandra, what's your thoughts?
I agree. The only point that I would make that's a little different is much of when we're looking at an acquisition versus an overall deal, one of the things that we're looking at is the strategic value of that particular company, both the strategic value that we bring and that they bring to us. Because if it's just simply additive, if it's just doing more of what we do, just mass, well, that's going to affect the valuation. In many ways, it really makes most sense in a case like that to have to make an overall deal. If we're going to do an acquisition, it's because there's a piece of the puzzle that we're trying to find. We're looking for a company to strategically advance us in a direction that we may have a bit of a weakness in, or simply that we need more. We're a distribution company as well as a production company.
And Michael is,
we need
sorry.
Yeah.
Okay.
We need something to fill the pipeline.
Right. And Michael, do you buy it? And not just on behalf of yourself, but on others who run their own production companies. At the end of the day, do you feel like, hey, I'm a guy with a company and I'm selling shows, and I could really use the networks, the relationships that these companies have to offer? And do you think, not just for yourself, but do you think that others see that value too, who are in your shoes?
Well, I think what I'm looking for, or would be looking for now, is much different than from a couple years ago. I think now it's really about international distribution. It's about marketing support, advertiser tie-ins. As I used to run programming at VH1, I didn't really ever want to see any of the big studios come in and pitch me shows, because almost uniquely the shows they were trying to pitch me were shows that had no relevance to VH1. I mostly wanted to hear from smaller producers or independent producers who invariably were closer to the ground and understood what we wanted better. So from a sales point of view, I can operate much more quickly and effectively and smartly and nimbly on my own. Where I can't operate as well as I'm not yet at a size where I can go do my own international sales in an efficient way, or go to the marketplace and find marketing partners and advertising partners in an efficient place, in an efficient way. And that's where I think the potential strategic hookup is.
And so I have to let you guys respond to the point about network executives feeling, if Electus walks in, it's a bigger show. If Lionsgate walks in, it's a bigger show. And if that's a good or a bad thing. And I mean, one thing to note for those who don't know is your buying habits, your creative habits led to companies like 51 Minds that were then ultimately acquired by Endemol. So it sort of comes full circle in any event. So do you guys have a response at all to how an executive might view a smaller company versus a bigger company as they walk in the door on the non-scripted side?
I think the difference is, I think you have to break it into network versus cable. I think networks are a little more nervous about who they partner with on productions, and they certainly would look to a company like Endemol, Fremantle, large companies to do big budget, especially the type of shows we do, Wipeout, Extreme Makeover, big stunt type shows. I think at cable, there's much more room for smaller producers, and one of the reasons we've allowed the companies we acquire to operate independently and continue to do the shows that were successful for them before we acquired them is so they're small enough and they're nimble enough to work with cable companies, and they don't walk in with this perception that we're part of Endemol now, so we have much higher expectations.
So I want to make sure I have enough time to put everyone on the spot around a couple more interesting things than some of the theoretical discussion here. So, we all sort of spend our time in this M&A world, and there's a couple big players in the non-scripted space who remain independent. And was hoping I could force you to either comment or evade comments on why, for example, Mark Burnett's company has not been sold. So, Drew?
Mark has built a phenomenal business, and again, it's Mark Burnett brand, right? And it's kind of similar to the advertising agencies. It's like when you need that one creative leader to still stay within an organization. He's just built a phenomenal business. The question for him is, will he ever get to a point where value meets his desired result? Meaning, is it time for him to go to a bigger entity for him and be able to get a payout? Or does he keep running a phenomenally profitable business that he currently has? I mean, that's the big question that probably he grapples with. at the same time, he puts great hits on the air year after year.
Sandra?
To me, a guy like Mark Burnett, who has built such a great business, there are only really two reasons why he would sell. One is because somebody is going to pay him a huge pile of money, or because potentially, there is something he wants to get into, something different that he wants to do that he's not able to make that transition on his own. But otherwise, there's, why would he sell?
And in that category, there's Craig Pelagian and Arthur Smith and other companies that have grown larger. Even just looking from the outside, you can tell that their EBITDA is going to be bigger than the majority of companies. What prevents a sale there? I mean, it's not as if you guys haven't talked to them, right? I mean, it's a small world in Los Angeles and New York. So what is the difference between closing with Authentic and not closing with Arthur Smith?
You asking me?
I want all of you to answer. And violate NDAs, nobody in this room will care.
I think it's kind of what Drew said, it's a question of expectations and what they're looking for. In the case of Authentic, they had grown to a size where they were looking for a partner to help them take it further and grow internationally. I think with some of the other companies you mentioned, they don't see the need as much. And so I think the deal would be driven more by dollars than anything else. And as I said, when you asked the first question, the more expensive the deal is, the harder it is for it to work out ultimately. And especially now with the way the economy has been, multiples are down 2 to 4 times what they were 3 years ago. But I think for some sellers, they still remember the deals that were done 3 years ago and come in and expect those same multiples, and the deals just don't work. It's not a question of the value or whether they're worth it. It's just you pencil it out and you can't break even on the deals, let alone make money.
Right.
And it's tough to find money at those deals.
Yeah.
The bigger the deal, the smaller the buyer audience is.
Yeah.
That's right.
Definitely.
Well, let's talk about bigger deals. So we spent a lot of time talking about sort of growing and emerging non-scripted companies and their ultimate exit. But whether it's CKX, who's constantly in the marketplace or not, depending on the most recent press release, and other big companies, we've seen Shed acquired by Time Warner, and most recently there's a bunch of rumors in the marketplace around Shine. And certainly, from my perspective, I would think that if Shine sells at that number, which depending on the person I talked to or the blog post is between $600 million and $1 billion, which would be a fantastic multiple. What does that do for your corporate businesses? And what does it do for the M&A marketplace in general? And Bob, maybe you can start on that one.
I think Shine's a unique asset, but it's going to sell at a high valuation and a high multiple. And I think I'll have to do a lot of explaining to my clients that, it's not apples to apples.
Right.
But it's going to set the bar.
Drew, you guys are building your story now as you grow and you perhaps extend out of just IAC, which you may or may not do. Does a story like Shine, where you guys, certainly Ben had a big part in the creation of that company, drive value for you?
Yeah, I mean, I think where we're at is it's great to get a comp like that if they get it at a great valuation. But the reality is that, there's a lot that we're going to be doing, and we just need to execute on that. We're at a stage right now where we're making a lot of great investments in and around the ecosystem of digital advertising and television, and we're betting that there's going to be disruption continuing to happen. We're just placing certain bets in certain areas. So for us, it's, the hope is that we're not just valued as one, de facto multiple based on a television. Maybe it's ultimately a digital play, an advertising immersed play, or something else. So that's kind of our goal, how we think about it.
Right.
At the same time, it'd be nice to get like a Groupon valuation or
Right,
something too.
$15 billion would be good for a company in business
6
for
billion
18
to
months.
15 billion.
Right. Well, I'm not sure that will occur. Now, from a Lionsgate perspective, where you guys have your own set of corporate issues, does a big price for Shine help justify your existence as a content company, or do you think someone says, well, Shine accomplished this in X years, and why haven't you done that?
Shine is, Liz Murdoch has built a great business there, there's no question. But she's had a very, very different business growth than Lionsgate has. She's done a very good job of rolling up very, very good companies. She's got a very nice portfolio of companies, whereas Lionsgate really was a, from the ground up company. We built through inherent growth rather than acquisitions. We have done some strategic acquisitions. We're in the marketplace all the time looking for additional acquisitions, but the Shine paradigm is not, Lionsgate. That's not our model.
Right. And,
it's a good model, but not our model.
Right, and it does feel like Ron Endemol would have been sort of an impetus for the creation of Shine.
Yeah.
Lots of people from the same countries, the same neighborhoods, doing the same model in fantastic ways. As you guys sort of, think about your own corporate challenges, does the Shine story help you recap? Does it help you with banks? Does it help you ultimately what we're concerned about, being a better spot to buy more companies? What does it mean for Endemol?
I think it certainly helps us in terms of kind of setting the bar for what Endemol would be worth ultimately if there's a sale. So from our shareholder perspective, I'm sure they'd be happy to see it as high as possible.
So it's interesting that we all compete for the same businesses, but at the end of the day, you're actually rooting for success from the same companies because it benefits us all. So before we get to questions, let's just talk about ownership, which we could spend a full panel on because it historically always drove the sales of businesses. And I know, Michael, when you started your business, you had a show where you, together with Lionsgate, were able to drive huge international revenues in the Paris Hilton show. And that really was rocket fuel for you. So talk a little bit about, you mentioned it, the economic change in your business because ownership is so difficult. And any specific challenges you can recall where you felt like you might get to the finish line with some ownership, but what got in the way?
Well, I think the economic collapse got in the way, and I think that as an independent producer and company owner who has to now worry about paying payroll and healthcare and all that stuff, it's hard to turn away a commission. It's hard to turn away $5 or $6 million in revenues when it's staring you in the face, and especially as the market kind of contracted. It wasn't like there was a whole series of bidding wars over different properties, and so you had to make a decision. Am I going to sell this, take the money, make a really good show, or am I going to walk away? And I think now that we've achieved a bit of ballast and comfort, and we have quite a few series in production, we can take certain properties and step back and say, you know what, this is only worth doing if we can get rights. I think the example of the Paris Hilton show, which was a really terrific 8-figure payday, and thanks to Lionsgate's distribution of it, and we did some really original stuff. We produced the show overseas for a couple cycles with Paris, and there's extraordinary interest in her internationally. That was a model that I could spend the next 5 years producing shows and giving away rights and have no value for it. But it's finding those handful of projects that are worth holding back and saying, you know what, I'm not going to go to market with this unless I get X, Y, and Z. Right. And we're at that point now with about 6 or 7 projects where we're really looking for those kind of strategic partnerships that can take something from an X to a 20 or 30X, which is really what the value of international distribution is.
Right, and so with the businesses you're building in mind, maybe we can get an M&A response to that, which is, with Authentic, for example, it was a company that has created a great amount of content but did not own its content, which was very different than 51 Minds and different than other companies you've acquired, and certainly different than Reveille when Ben started it. So does it still matter? Do you have to own your content in order to be acquired? And if not, why the change?
I think it depends on the goals of the acquirer. And it impacts valuation. If a company owns rights, there's going to be a higher valuation because there's more to sell ultimately. Mm-hmm. And if you're talking about an Endemol that owns, we now have 6 operating companies in the U.S., our perspective is going to be different than a company coming in from Europe that's just trying to establish a beachhead here. So I think it depends, but I think ultimately the rights question is driven by the content. If you have 4 networks that all want the show, you're going to own it. If you have one network you're begging to order a pilot, you're not going to own it. Right. And one of the things that we try to focus on is this question of ownership of rights versus the value of the rights. We'd love to own 100%. That's not going to happen. But What we'd like to do is control, because we know we're going to maximize the value. And what we've seen a lot is the channels will insist on controlling, even if we have a 50% participation. But then they won't do anything with it because that's not the focus. The focus is putting the show on the air. And we're saying we have merchandising people around the world, and we have international distribution people around the world. And there's so much more money we can generate for everybody.
Yeah, actually,
And that's really the fight we have.
Yeah, I mean, actually, if I can jump in on that, because I mean, we've actually never spoken, but actually our paths are intertwined. When I was running programming at VH1, we made the overall deal with 51 Minds that essentially gave them all rights for their programming in return for a cheaper licensing deal. And part of that was driven by the fact that I was noticing internally that we were retaining rights but not doing that much with them. Not in all cases, but not doing enough with them to warrant the battle. And in part because of those shows, and in part because of the creative collaboration we had with Chris and Mark, we made them very rich, but we also doubled VH1's ratings and made billions of dollars for Viacom. So I think that there's a kind of more sophisticated way to look at this, where everybody can win, and make sure really every part of the chicken is getting used.
But it's also really a show-by-show analysis, because there are certain shows that you're going to have. It would be really great to have ownership, but frankly, there is very little international value to a lot of the shows that you do. So it becomes a theoretical argument. I mean, it looks better on your balance sheet to be able to show an asset, but from a very practical standpoint, it really doesn't make a difference. With our TV guide hat on, we look at all of the properties that are coming into us as, is this something we need to own or not?
Yeah. The difficulty,
it's a case by case.
The difficulty, and Brian and I have spent a lot of time talking about this, is knowing when you sell the show. And you look at a show like Authentic's Ace of Cakes, about a baker in Baltimore, and you would think, well, that's not going to have any value around the world, and it turns out to be a global hit. So it's really frustrating when we talk to our international people, our merchandising people, and say, here's a show idea we're about to sell. What do you think it's worth around the world? You can have an educated opinion, but ultimately, you just don't know.
So then, Drew, I'd ask, you just announced an overall deal or a big deal yesterday with Tony and Liz. Would you buy companies that don't own their content? Would you buy them because they can produce the next Ace of Cakes?
I mean, again, I think that we would look at personality driven for that, and how, I think kind of what you saw with Authentic is, a gradual step of great shows, better access, better terms on their deals, and that comes down to, who these people are and can they deliver hits after hits. Because Michael said it the first time, you need hits in this business. I mean, it's, I like to say you get in the Hall of Fame for batting 30% in baseball. It'd be good for us here in television too, but you need hits, and with hits, you get more leverage. I mean, Ron just said it, if you have a show and you've got networks competing against it, you have the leverage. If you have a show that you need for international sales, and you only have one buyer, it's going to be a harder negotiation. So for us, we'll look at those values, but for the most part, we're just going to be looking at the personalities.
Well, I have more to ask you, and actually a couple companies to sell to you along with Bob. Sure. But before we get to that, are there any questions? We have about 10 minutes left. All right, good. We'll jump back in and put you guys back on the spot for the last 10 minutes. Bob, what do you think is the likely outcome over the next year as you look at sort of private equity interest in this model and what you're hearing on the stage? Do you think it's a time period where you'll get more companies acquired? These things seem to go in waves. What do you think if you're sitting in the audience and you run your own company? Is it a time to look? Is it a time to hold? What's your thoughts?
Sure. I mean, I think that the private equity, there's a bunch of new funds that are being established that are looking at this market. They like the reality-based market because of the high margins and the clarity of the cash flows. So it's sort of an easier business to understand. And they see the success. I mean, the industry's had a lot of success on a low-cost basis compared to other investments. And the banking market continues to come back. I think the big issue here is going to be the size of the deals. Because the smaller deals, I feel like there's going to be a lot of velocity on those. They're going to get done. The makeup of the company, each of these companies is specific to themselves. So if it's very asset-laden, The cash flows could be up front. If it's employment driven or talent driven, the cash flows are going to be spread and back ended. But the big deals are going to be tough to get done because the banks are making smaller loans. It's going to hurt the returns.
And as buyers, do you agree with that assessment?
Certainly that's what we're seeing. The big, putting the Shine deal aside, because that is kind of a unique situation. We're finding pricing, the price of the deals is a lot more realistic this year than it was 3 years ago when we were out looking at deals. And so it's easier to find money to finance those deals. Those deals are easier to get made.
I think the question from a private equity standpoint is more kind of a global question about private equity investing in content.
Right.
And when you have a business that's driven by hits, and you sit with your private equity owners and they say, are we going to have 10% growth this year? And you say, well, we could have 50% growth, or we could have 5% growth. It depends on whether the show's a hit. That's a difficult thing for them to stomach.
That doesn't sound like something that would make a bunch of private equity guys comfortable.
That's why it comes down to being with the right buyer. You need to know your audience.
Yeah. And I think just on a flip side, I think that the TV production business is becoming more like the digital startup business, which is the barriers to entry are very low, the cost of production is very low. If you're willing to run lean and mean, it doesn't cost that much to get into the business. And one of the joys of the TV business is that when you sell a show, it's cash flowed. So the question from our end is, do we need private equity at all? Much in the same way in Silicon Valley, where the amount of money you need to start up a company sometimes is a couple $1,000s. So that I think is probably changing quite considerably the way an independent producer might look at potential partnerships.
And so, pushing on to your thoughts about the internet, I mean, Drew, do you guys see, as someone who produces internet content, how do you look at the folks that have focused on internet production exclusively? And why have they not been acquired? So you look at all those folks, and they've all been to everyone's office, and they're doing great things and working hard. But the economics of producing content for the internet are just not close to what they are for television.
I think it's been interesting because a lot of the digital content's been driven by one thing, and that's advertising, right? So you need the advertising market to, if you're doing a digital show, whether you're putting it up on YouTube and you're hoping that the YouTube's generating the ad sales against it, or if you're doing it as a sponsor integration and you hope that the brand is paying for that, or if you're doing original content, you created your own O&O. We have an asset, College Humor, which is some of the young, great, talented young comedians out there that they're generating a tremendous amount of original content on a weekly basis. We have it on our network where we're selling ads against it. We have it where we sell it, put it on YouTube, sell ads against it. And we're also looking to take that opportunity on different platforms as well. They've had success, though, as well, that we look at taking a show like Pranked from College Humor to MTV, the College Humor show as well. And although there's been a lot of steps in that direction, the hope is by doing that there will be some more successes, because if you have brands that are already looking at that saying, we like this idea, we'd like to see it on a bigger platform, we'd like to put our dollars against it, the marketers are saying, well, you already have an audience out there that recognizes what this program is about, maybe our marketing is able to leverage off that. So that's always been the big hope. But I think the starts and stops of that has happened because of the advertising market, where the advertising market, grew up, and when the economic downturn happened, it went away, and now I think we're seeing it build up again. But I think it's a little bit more, as we're seeing some successes here, a little more smartly generated and understanding what the audience wants. We saw the success of Hulu, people actually watching 22-minute and 48-minute episodes online, and also now looking at original content and looking more video. So, I do think that that's an area to place some bets, and but still the ultimate hope is, how do you retain and get more dollars from that ultimately if it goes to a new platform, and merchandising and these other ancillary revenues wrapped around it.
Right, and Sandra, you own at LionsgateBreak.com or a large piece of Break.com and other assets, and there's companies like Revision 3 and Next New and others, as we talked about, and the stuff Drew is pointing out. Is there a time where Lionsgate focuses on the acquisition of companies that produce exclusively or primarily for the internet, or do you think of it as a guy like Michael, who's great at producing content, will just produce as well for the internet?
We're starting to think less in buckets, that this is just an internet company, this is just a TV content company. we do a lot of work with Break, and we go back and forth, bringing them our content, looking at their content. To business, we like, particularly as the advertisers are looking at different ways to participate in online content. No longer simply giving you, very low dollars for what's essentially a TV model, but looking to be much more integrally involved in the ownership, in the purchasing, the acquisition, and the creation of the content. Not from a creative standpoint, but from a fundamental standpoint. So we are looking at that space, and the people that we are looking at are companies like Break that really feel like they have the capacity to operate in both spaces, to either start online and migrate into television, or vice versa, with that creativity.
I think in a year or so, given Google TV and given Wi-Fi enabled TV, Apple TV, and so forth, there's going to be absolutely no distinction between web and television, and and the browser is going to start being seen as vestigial. So I think it's really about financing models, production models. As a viewer, it's all going to be experienced the same way in a very short amount of time. One of the things that we're even prepping for is, why don't we start distributing our own shows? And as we set up our own website, set up our own distribution system, I think there's going to be some really radical disruption in how TV is created and distributed.
I think the difference is when you talk about M&A. We've looked at producing for digital, and it's a good business for us. And in some cases, we make a margin in excess of what we make on a small cable show. The problem is scalability. And we look at digital businesses. You develop a show, you go out, you have to sell it to advertisers, you have to build a distribution plan, launch it, make money on it, hopefully. And then when you're ready for what you call season 2 of that show, you've got to go out to those same advertisers, make sure they're still in, find new advertisers. So it's difficult, if you're doing that for every show, it's difficult to scale it to a point where you can justify paying a multiple.
Yeah. The hope there then is that some of these online destinations start recognizing what franchises are and supporting those franchises. So for example, it garnered an audience for me. I was able to sell against it. It was a good value proposition to my end users. Why don't I do that again and make the bet that they'll come back and I can sell even for more money?
But they're still not doing license deals like they used to.
They're not, but I think that's where I think you're going to start seeing some differentiation, the hope, from a lot of these, because ultimately online you have many decisions to choose from. And if they're going to try to, change the perception of come here, stay here on our site, our destination, because we offer you something unique and different, that's the hope. It's not, you're absolutely right, it's not here yet, but that's the hope, that because it's a two-way street on that.
It comes a little full circle to something we started talking about earlier, the overall deal versus the acquisition, because then it makes a lot of sense, particularly in the online space, to acquire a company like Break, to actually acquire a company where you can then share backroom operations, so that you're not going out and selling advertising piece by piece. You've got an advertising division that's selling across your slate, that's selling across the network. So you are making savings such that it is strategically smart to actually have the complete platform rather than just show by show.
It's just difficult to find those breaks. Break has distribution. When you look at a lot of companies that Brian mentioned, they don't have any distribution. They're great producers, but it's tough to sell.
That's why so few of those deals get made, because it's hard to
So
find those companies.
I think we're out of time, but before we go, I was hoping each one of you could just indicate what companies you intend to buy next. No one will, we'll keep it just in this room. But if you're uncomfortable doing that, I'll just say thank you very much for your time, and thanks for joining us today.
Thank you. We're probably all looking at this.